Welcome to Wizards Institute, the #1 community to learn smart investing and financial independence.
Great. Hi, Brad. Welcome to the channel. Today, we're very excited to have Brad Shepard to share with us his diverse investment and real estate experience. Brad, we start, maybe you could just give us a bit of your background, what you're doing, and what kind of stuff you're investing in.
Sure, absolutely. I'm happy to do that. And thank you very much for having me on. So what I do currently, I've been in the real estate market, in the real estate scene for the last 20 years, since basically right after I graduated college. And I've learned a lot of lessons. I've taken my bumps and bruises, but where I've really found my joy and what I really am passionate about helping other people discover as well, is large commercial syndication. So I actually operate as a co-syndicator with a number of different operators. Most of them are in the apartment housing space, but we also work with some that are in the self-storage units, mobile home parks. And I come in as essentially an investor relationship specialist, bringing dollars to the deals. I'm part of the general partnership, but my role is really educating other potential investors about this investment class that they have available to them, rather than their standard 401ks, IRAs, mutual funds, et cetera, that everybody knows about, but they're kind of dull, not generally controllable. But I really love educating people about these, the multifamily in particular, syndications. But prior to that, I've taken my licks with Airbnb properties, fix and flips. I still own a small portfolio. I've got about a dozen units of single family rentals. Prior to in a prior life, we even had a small hotel and some bread and breakfasts. So yeah, dabbled in a little bit for the last couple of decades.
That's great. You're getting me excited because certainly multi-family apartment, workforce housing, which sounds like this is what you focus on, is also one of my personal favorite asset classes. So when you say large commercial, are you talking about apartments? Are you talking about malls? Are you primarily residential?
Yeah, residential, primarily residential.
Okay. And is it workforce, like the B's and C's in the apartment side?
B's and C's. We haven't done any A class. Maybe some you could classify as maybe.
Okay, fantastic. Okay, and you mentioned self-storage and which is obviously industrial, but you also do most mobile home parks, which is workforce. So is mostly on the workforce side, or do you also spend quite a bit of time on the industrial side, or the self-storage?
Yeah, the self-storage, we're picky there. Certainly classified as an industrial, but it's not posh. We've built some that are climate controlled, that we've turned around and upgraded to something that we would want to use. You and I would feel comfortable going there on a weekend, on a weeknight, late at night, to retrieve our stuff. So it's B class as well.
Gotcha.
Yeah,
Great.
And even the mobile home parks, we like to have properties where there's pride of ownership or pride of residence, we should say.
Sure. And in which markets do you invest in currently?
Yeah, we like the South. So we have a lot in Texas, Charlotte, out in North Carolina, Florida. We've got a couple properties in Tampa and Orlando.
Oh, really? Okay.
Mm-hmm. Yeah, one of our self-storage units is actually down in Key West.
Okay.
That one's been a fun one. And then we do have a mobile home park, a couple of properties out in Arizona as well.
Gotcha. And typically, what size assets are these, Brad?
Yeah, generally, the apartments are going to be 250 units and above. That's kind of our sweet spot, is around 250 to 400 units. Mm-hmm. The self-storage unit, the one in Key West, that's about an 800 unit property. So it's that kind of a range. Generally raising 20 to 30 million per asset.
Gotcha. Okay. Then I'm still on your bio. There's a lot to unpack. So
Sure.
then you mentioned your job is IR, which is investors relations. So your investors, are these W-2 earners, high net worth individuals? Are you targeting family offices? Are you targeting institutionals, or all of them?
Yeah, really, it's been on the retail investor side. So I work with
Okay.
ER physicians, lawyers, entrepreneurs that primarily W-2, or they've done well with their own small businesses. They know the value and the attractiveness of real estate, but they don't want to get their hands dirty with it.
Gotcha, gotcha. And so your role, so you mentioned you're a GP, which means you're a partner or sponsor of these assets, but you have partners. Do you have different partners in each geography to look for the deals and to do the other aspects of the projects? And then your role is really the investors fundraising as well as the management of investors.
That's
Is
exactly
that
right.
correct?
When I felt was starting to feel burned out on the single family side and wanted to get into the commercial space, I had originally the idea that I would develop relationships with brokers, I would raise all the capital, I would figure out the property management. And as I got going into that, I was starting to look at deals. I was starting, I had several under due diligence, and realizing that the folks that I was competing against had all those systems and those networks built. I wondered, is there a way to team up? Is there a way that rather than me competing against these folks, could I partner with some of these successful operators and bring investors to the table? And so I found a really good niche that way. So rather than me having to go through all those efforts and duplicating, creating my own team, I was able to partner up with several other different teams. And so I've been able to select, I've got 3 on the multifamily side. One focuses in Texas, one focuses in Florida, one focuses in the Carolinas. I've got a different operator for the mobile home parks and a different operator for the self-storage. And so I'm part of that team. But they've already got their systems. They've got their years of track record, the professional property management in place. So even for the general partners, by and large, the day-to-day stuff of toilets and tenants, that's handled by on-site property management.
Sure, sure.
But even to the just executing a business plan, the partners that I team up with, they're the ones doing that, primarily focused on
Gotcha,
that
gotcha.
element as well.
So what makes you so good at the investor side? What was the background, or are you just a very good sales guy? Oh, everything.
All the above. All the above.
Yes,
I'm not a very good sales guy. But I love telling people about it. I've been doing real estate for 20 years. And so I've seen what works and what doesn't. I've been out there with the shovels and hammers and in the thick of stuff. And so I can speak to it from an experienced angle. And then just my professional network, having my 15 years of a W-2 job and the people that I was able to associate with, associate with high earners, church networks, business,
Wow.
just seeing these individuals who, I felt like could have interest and the ability to invest in these type of opportunities. I've been able to, it doesn't take hundreds of these folks, right? It takes dozens, and you get a few, and even a dozen that are willing to be repeat investors or have the ability to be repeat investors. You can generate quite a bit of capital that way.
Sure. Okay. So I've got a cousin, Wall Street, 25 years, makes 7 figures, pays taxes, W-2. I've tried to introduce her to this asset class as a passive to reduce the taxes. Her husband's a bit more cautious. You have 2 minutes, 3 minutes to convince the couple. What would you say to them?
Yeah, one is, if they're all in on stocks, what happens with another 07 and 08? How much control do you have in that? It's what is the actual hard asset that drives need? It's for me, the stock market feels a bit, who's the last fool wanting to buy? You've got to find the greater fool to sell your asset to.
Sure.
And when things come down, you start running out of fools, and your prices, the buyers are just harder to find. When it comes to real estate, everybody needs a place to live. Everybody's got a ton of junk to store. So there's always going to be a need for this asset class, and that's not to say you have to choose one or the other. If you've got passive gains over there on the real estate side, so maybe not their W-2s, but the dollars that they have invested, they've got some passive gains there. Well, we could offset that with some passive losses from the real estate side and help them improve their tax situation as well. Because these real estate assets are really good at generating cash flow but on paper, they're generating passive losses. And so those can be really useful for individuals like that who have a lot of dollars in the stock market generating passive gains. And then just when we look at the long term, how real estate has performed against the stock market. If your cousin who's very specialized and he knows his thing, he knows how to pick the winners, he's got a great track record, awesome. But if we're just talking about folks who are putting in their money in with the index fund, we can outperform that. When you look at what's been achieved in real estate versus the market as a whole on the stock side, for me, I think real estate comes out as the winner every time, especially when you look at the tax consequences. The government encourages us to invest in real estate, and so there's a lot of tax advantages to doing so. So that's really high level. Your cousin would have, several retorts to come back with on that. But I think there's really a good argument for why real estate is a superior investment class to stocks. But again, it doesn't have to be an either or. They can be part of the same portfolio for sure.
So if she were to invest, let's say in an ETF, an index, long term, right? On average, maybe you're getting 7-8% from the stocks, with a lot of liquidity.
Right.
Liquidity. And if she chose to work with you, realistically, what are we getting?
Yeah, and so the liquidity, I mean, that's a big one, right? So when you're talking about a private placement, which is what we are doing on the real estate side, it is you're going to lock your money up for 3, 4, 5, 6 years. So that's where stocks will definitely win, is if they need liquid capital. But the properties that we're talking about, on average, we're talking about 15, 16% annual returns on an annual basis. And that's going to be your annual cash flow plus an equity event, whether that's a sale or a refinance along the way. And that's the conservative number that we're generally going out to our market with when we're raising funds. We're talking about a 15, 16, 17% IRR. And then doing our best to surpass those conservative projections. And we've done well there. So I'm not going to throw out those numbers, but when we're talking about what are the conservative projections that where we're working with investors to entice them to put the dollars with us, that range of 15, 16, 17% returns, we're saying generally an equity multiple of 2x. So if you put 100,000 with us, at the end of the day, once the project is complete, we should be able we're delivering back to you 200 grand. So and again, with the conservative projection. So when you think about long-term 7, 8, 10% in the stock market, what we can do on the real estate side, it can be quite a bit stronger.
Sure. So how long have you been doing this? How many projects have you syndicated and executed?
Yeah, we are in 9 so far. And that's with me as the GP. My wife and I are also limited partners, meaning passive investors on 3 or 4 other properties. That's what we did first. We first wanted to, when we first got introduced to this market, we went in as passive investors. But where we focus on, where we're on the active side and bringing others into the deal, we've done 9 so far. 2020, that was going to be our breakout year. We were expecting to do probably 6 or 7 just this year, and we did 0 this year. When we closed on one. We closed on one that was already well down the pipeline prior to COVID hitting. And then once COVID hit, we just really put the brakes on.
Yeah. What year I'm going to just grab water. What year did you do your first project, Brad?
2017.
2017. And so you talked about projections. How have the ones that you've done early, how have they mapped to your projections?
Yeah, so most of them are still underway. We've had one that closed earlier than we expected, and that one did well. Our investors on that one came in somewhere around 24-25% returns on that one, and we sold earlier than expected because of how well the business plan went. The market did really well, and we had a strong offer, so we went with it. The rest are still in play. Most of them have done really well. We had one property in the Orlando area where occupancy struggled this year. It was right next to Disney World, We had a lot of tenants who were Disney World employees, and it's also where you also have a lot of small colleges, private colleges in that area, and so that was a big pool for our tenants. And so when those kids got sent home and Disney World closed, that took our occupancy down to the high 80s, and so that's our poorest performing asset right now. I mean, our break even on that property is an occupancy somewhere around high 60%. So we're still making distributions. It's just not going to perform as well as the other assets go.
Yeah. So these are typically like 3 to 5 year holds, Brad?
Generally, yes. We generally say about a 5-year hold to plan on.
Sure. And when you say you forecast 2x, what portion of that is from the appreciation exit, the capital gain versus the cash on cash?
Yeah. So if you put, it's generally about half and half to be honest, because we see that cash flow somewhere in the 10% rough range. Again, just real rough numbers there. So you could expect 10%, 100 grand, 10 grand each year for those 5 years. There's 50 grand, and then another 50 grand coming from the exit. And so that 100 grand being returned in excess of your capital. So it generally breaks out to that type of rough math. Half of it coming from the annual cash flows, half of it coming from the equity event.
Right. Sure. So yeah, Brad. Again, I'm a GP as well as an LP in this asset class as well. So I've thought through personally why I love this asset class, which is also why I wanted to talk to you. But in your view, you've also looked at other asset classes. You come from a different experience than I have. Can you summarize for our audience, maybe even mapping to our 10 commandments of investing, why is this asset class, you're obviously very passionate about it, why is this asset class so attractive to you?
Yeah. So for me, what it brought was solid, predictable returns in an asset class that I know and I understand. I like real estate. I like physical assets that I can drive to, put my finger on the bricks. So here's what I own. I own a slice of this. I have an influence over this property here, as opposed to stocks where it's just, you've got zero influence. And if you're in a fund, who knows what you have to dig pretty hard in a prospectus to really understand what your fund is invested in. So I like those single asset investment opportunities. And then enjoying that aspect of real estate. Okay, do I go buy a bunch of rental properties? Do I buy some 3plexes, 4plexes? Well, I've done that, right? Even if you have a really good property manager, you're still going to get phone calls about, hey, do you want to, the AC just broke. Do you want to do it this month or next? That we need to replace the refrigerator. It's, hey, this tenant's giving me some grief over here. So you're still, even with a good layer of property management in there, you're still going to be involved in the property, the day-to-day stuff. Fix and flips. For us, what we did those. Most of them went well. We just learned we don't really like being the ones to pick out the tile and the paint colors. Some people love that. They've got that creative mind. For me, what I liked about the passive and the larger commercial properties is it's a business. It really is. You're buying a stream of cash flows. It doesn't have to be in your backyard. It's you can buy a property anywhere in the country based on fundamentals of the team, the asset, the market, and you can spreadsheet it really well. Say, is this worth my dollars or not? Where a rental or a flip, because they're smaller units, smaller compressed timeline, those can go off the rails quite a bit, much more drastically. Plus you're getting your hands a lot dirtier. So my wife and I've really enjoyed the professional aspects of the larger properties, professional teams, professional sellers, professional management, etc. Sure.
So all the benefits of real estate fix and flips and small ones, but without the day-to-day, since you've got scale to employ third-party property management.
Exactly. Right. That scale makes a huge difference.
Gotcha. Okay. You have kids?
I have 2 kids.
Okay. So what kind of advice, if they're old enough, are you giving them from an investment standpoint? What are the mantras that the Shepherd family is giving the kids from an investment? Not trading. Again, we're focused on long-term investing.
Sure. I've got a 4-year-old and a 1-year-old. So the 1-year-old.
Okay. So, no. Given
But
your brain power, I'm sure you're starting already.
the
But yeah.
4-year-old for sure. We went out on Saturday and we noticed that one of our neighbors had a limb blocking the sidewalk. For weeks we've had to duck underneath this limb to get by there when we go on our family walks. So my boy and I, we went and knocked on her door and asked, would you mind if we chop that down? We didn't know this lady. She lives 8 houses down, but we thought, let's just go see if we can help her out. So she was incredibly nice. We learned that she had a heart attack earlier this year, wasn't able to do the yard work. We chopped down the tree for her. We were thinking, it's just something fun to do with my boy. We were just having a good time. And when we were done, we had it all nice, stacked up really nicely. She came out and gave us $20. You should have seen my boy. He was blown away. Dad, how many other trees can we cut down? He was loving it. We've had these conversations, and then we came back. We talked about a percentage of that for saving, a percentage of that for tithing in our church, and then percent of that for having fun with. We have some of his. We actually have a Coverdell account and with a self-directed IRA custodian that we've invested in apartments. And so we've driven to those. That one is here in Austin. We've driven to those and told them, hey, you own, little boy, you own a slice of that as an owner and investor. So just really early with him still, but just dropping this idea of we're not just getting this money for consumption, right? What else can we do with this money? That $20, yeah, we could go to the store and spend it right now. What else can we do with it though? If we don't spend, what are the other things we can do with it? Should we go put that in your IRA or your ESA, or give a little extra to somebody we know who needs some help? How do we really leverage that income that he as a little boy is seeing come across his desk?
Sure. When they get old enough, Brad, what book or books, what 1 or 2 books would you recommend that they read, or force feed to them?
Yeah. The ones that really influenced my thinking, going back 20 years, Richest Man in Babylon, that idea of just don't assume everything. Rich Dad, Poor Dad, I know that's very cliche, but that one was a turned on a lot of light bulbs for me. And I don't think he needs to read the 10 other books that came after that one in the series, but that Rich Dad, Poor Dad is just a really good, just a light bulb generator, I think. And I'm a big fan of Napoleon Hill as well. His 16 Lessons for Life. I've got the.
Okay, I haven't done that one yet. Okay, that's great.
Napoleon Hill and his Think and Grow Rich, plus the expanded version of that is the 16 Lessons. Phenomenal, just way to approach life.
Great. Yeah, I've got. No, that's insightful. I've got 3 kids older, all in high school now. But when they're in the between ages of 8 to 12, I did force feed all 3 of them Rich Dad Poor Dad and 4-Hour Work Week. And
Nice.
Even though they hated it, they say they hated it. It's actually registering. And so obviously Rich Dad Poor Dad teaches a lot of things that, especially Asian parents, says go to school, get a job, right? And then the Tim Ferriss teaches that it doesn't have to be 9 to 5 as well, right? We're hoping our book is really the 3rd book that kids read, because it's about really taking that mindset and learning to invest and in a smart way, so that they can achieve financial freedom. So which is why we have you as a guest, to learn this particular asset class.
Yeah.
So.
And I'm real curious to discover my 4-year-old as he grows. I mean, it really is a discovery process. If he tells me he wants to be a doctor or an attorney, sure, okay, you got to go to college for that. But if you want to go to college to be get a general business degree or humanities, all right, maybe there's another route we could go to be a little bit more productive right out of the gate. I mean, you can't discount the relationships and the maturing that can happen at the college scene, but we're not looking at it as you've got to go to college or bust. Based on what his personality and preferences are, does he want to start flipping houses when he's 18 years old, or does he want to go be a doctor? Okay, different conversation. So we're really excited to discover him and what path he's going to go down. But regardless, yes, making sure that this idea of putting your money to work rather than spending it, follow these commandments of investing to make sure you're going down a path that's true to yourself, rather than just go to college, get a job.
Sure, sure. Hey, Brad, this is fun. Thank you. I wish I had more time, but the time is up. How do we find you?
Best way to find me is at our website, it's sugarhouseinvestments.com.
Sugar. Okay, great.
Connect with me if they want to learn about their future investments. They can sign up on our distribution list there as well.
Wonderful. All right. Thank you so much.
Thank you, Zan.
All right. Thank you.
Thank you for joining us. Please visit Wizards Institute to access the blog summary of today's session, to learn more about other speakers, and to network with other investment wizards. Wizards Institute, the #1 community to learn smart investing and financial freedom.